JSE-listed fintech group Capital Appreciation reported financial results with headline earnings down 11.1%. The decreases were largely due to the delayed delivery of a substantial order of terminals after the year-end cut-off period. The company provides technology that banks and other financial services companies use to add more digital features to their digital platforms. However, the business did not escape the effects of the pandemic. Earlier, I spoke to Alan Salomon, who is the CFO at Capital Appreciation.
It has really been a tough and challenging year, but notwithstanding that, I think Capital Appreciation has delivered a commendable performance.
Right. Let's go through some of the salient features for the year that was. I mean, what stands out to you when you look back on it?
I think the noteworthy events and the accounting treatments that affected the comparability of our set of results for 2021 really have a couple of key areas. The customer's capital investment in payment terminals has consistently over the years been unpredictable, uneven, periodic and time inconsistent, and therefore does not really follow financial years and cut-off reporting periods. That effectively accounted for the fact that we had substantial orders that were placed by our customers in the latter part of our 2021 financial year. But due to a variety of reasons, those transactions were only executed in the first quarter of the 2022 financial year, which obviously gives us a very, very good and useful springboard for the next reporting period. I think the other salient area which affected our earnings was the significant drop of 300 basis points in the prime and the repo interest rates. And we're sitting with a substantial cash pile of an excess of 500 million. And obviously the earnings yield on that substantial asset base was materially reduced by 17.5 million rand.
Right. Let's look at the underlying businesses. Let's start off with Synthesis. The story there, how has that part of the business developed?
Oh, no. So we acquired all our businesses. We originated as a SPAC, a special purpose acquisition company, in 2015. We made our primary acquisitions in May of 2017. And as a Synthesis, as business has grown in leaps and bounds, has had compounded strong growth in their revenues and their profitabilities in excess of 25% in each of the years. And obviously it was a little bit subdued this year by virtue of the wait-and-see approach from their customers. The customers generally didn't have clarity as to what was going to be the financial or the economic fallout from the COVID-19 or how long it was going to last. But fundamentally, software platforms that have been developed by Synthesis are very, very well received and are significant contributors to their clients' performance. And there's an encouraging pipeline for their products and services, and they've delivered, as we can see by the numbers, a commendable performance.
Alan, to what extent has the strategy for Capital Appreciation changed from pre-pandemic levels to now? I mean, you mentioned the effect of the pandemic. I think the pandemic probably affected every type of business. But from Capital Appreciation's point of view, how has strategy changed to accommodate so many new changes that are happening right now?
I think our strategy, right from the time that we originally listed to where we are during the 21 challenging pandemic year, has not changed. We're in a financial services, we're in the financial technology sector, and technology, as you can see globally and in South Africa, is growing in leaps and bounds. And we've seen that the pandemic in some areas has created greater not only awareness but demand for our products and services, and we'll see that continue into the foreseeable future. But the strategic direction didn't change. Unfortunately, the makeup of our group didn't change because we're very, very well organized, we're well disciplined, we're compliant and governed well. And more significantly, we've got a very, very healthy balance sheet that allows us to continue to develop our infrastructure for future time periods.
Right. Looking at, the next phase or what ticks the box for you as a group when you're sitting in that boardroom, what are you looking for in terms of the businesses that you invest in? In which regions would you be looking to expand or at least have a footprint in?
Well, we obviously started off with concentration in our home base in South Africa. We're very much a South African homegrown group and businesses. And we will continue to develop it. We still see significant potential in South Africa. But we also see our role to become a potential springboard into other parts of Africa. And our activities, both in the payments division and in the software division, have already seen greater traction in its activities outside our border. We're now operating in 10 countries outside South Africa. And even over a modest base, we generated 41 million rands worth of revenue outside of South Africa. And it's now represents 7% of our revenue, as opposed to 3% in last year. So there's no question about we're making sure that our home base is on solid foundations, which it actually is. And that gives us the ability to focus wisely and cautiously in other territories.
On that note then, before I let you go, the outlook for the company, what's next for the next 6 months or so?
Well, we're not good at giving forecasts, and we will never give forecasts. But the pipeline is strong. The economic activity, the growth rates, and the further effects of this now unfortunate third wave creates further uncertainty. But we really are building the group capital appreciation for the medium and for the long term, and therefore we wisely invest in going forward. We're not looking for short-term wins as opposed to the opportunities that we see in the medium and long term. So we're very optimistic that the group is in very, very good financial and got a very talented management team, and that the future looks bright for us.
That's it for now. We'll have more news at the top of the hour.